It's a big deal. We're talking, this is going to end up being 3 to 4 trillion, maybe 3 to 5 trillion of extra liquidity. So you've got a lot of liquidity things happening all at the same time. In the middle of that, you've got the Clarity Act, whether it comes end of this year or by mid-Jan, it's coming. And that allows everybody to use crypto because it will have been defined and how to use it. So we've got an extraordinarily powerful year ahead of us. We've had to go through the hard part, which was this liquidity squeeze, but that will give us what we want going forwards. And looking at it 3 months, 1 month, 9 months, 1 year still doesn't make sense. My entire thesis is the length of the cycle. I think the length of this cycle is 5 years. I changed my view. I thought it was going to be 4 years, but my forward-looking indicators kept pushing out. I'm like, why is this happening? And then I realized the debt. And so 5 years is my time horizon.
Raoul Pal begins by emphasizing a foundational principle of macro investing. Short-term market movements are dominated by noise, while long-term trends are driven by structural forces. In crypto, those structural forces are primarily network adoption and currency debasement. These are slow-moving, compounding dynamics that can be forecast probabilistically over time. The problem, Pal explains, is that investors want precision. They want charts, like M2 money supply, to line up perfectly with asset prices at all times. When those correlations break down temporarily, confidence collapses. But in reality, these deviations are normal. Markets do not move in straight lines, and no single indicator works flawlessly in the short term.
Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
The short term is more dominated by noise or shorter term factors. The long term is driven by the two key factors, network adoption and debasement of currency. So it's much more forecastable, probabilistically so. The short term is less so. So of course, the short term deviates from the long term often, always does. And people don't want to believe that. So, right, everyone put their hopes and dreams into the M2 chart. I said it's not going to always work perfectly. Everyone reads that as Raoul says it's going to work perfectly and it's always going to match. So then it deviates. So then my job as a macro analyst is to figure out, why is it deviating? What's changed? And you see it deviating on lots of charts, from monetary measures to historical parallels. And it's like, okay, something here has happened that I don't quite understand. So I then do the work on it. And I figure out, okay, this was to do with the and we can talk about the details of it, the withdrawal liquidity as the Treasury built the general account. And so it's like, okay, it's understandable. We see what's going on. So you adjust your understanding of where you are in that long-term trend and what's going on, and then had the government shutdown. People don't see that. They think it should all work perfectly. It never can do, because the short term always has a lot more noise to signal ratio, and the long term has all of the signal to noise ratio. I keep trying to explain to people, it's all about liquidity. It's the most dominant macro factor of all time right now. It's one game. One game is, what is liquidity doing? The second game we overlay in crypto is, what is the adoption of the particular token asset you're using? Whether it's a layer 2, a layer 1, an applications layer, DeFi, whatever it is. It's like, what's the speed of adoption on top of what's the amount of debasement going? That's the whole game we're in. So people need to figure out that whole game. Then it gets a little bit complicated, because how do we get liquidity? So liquidity in the traditional crypto speak was quantitative easing. They're printing money, but they stopped doing that. And then you have to figure out, oh, it's FedNet liquidity, which is the Treasury general account and the reverse repo. And if you think about that being the only liquidity that was in the system, they drained the reverse repo. And the Treasury general account is a checking account. They fill up, drain, fill up, drain. So this keeps going up and down. It doesn't actually help with liquidity. This draining of the reverse repo was the liquidity that we saw. So the liquidity kind of rate of change has been low. So that's one element. Liquidity rate of change has been low. Then we've had an extension to the cycle. People said there was like some Satoshi from the gods said, there shall be a 4-year cycle. It shall be so. It's bullshit. There has to be a reason for it. It's the same reason the ISM was a perfect cycle. It's the same reason the NASDAQ year-on-year rate of change is a perfect cycle, all the same. They're all driven by this debt cycle we've talked about. From 2008, they reset interest rates to zero. All major countries put their debt into the 3 to 5 year bucket. And so every 4 years, we roll the debt. Now, I start looking at why is the business cycle not picking up? Why is my thesis not working? While the online attackers like, see, his thesis is bullshit. My job is to say why, to understand why it's not working. And then so I did the foundational work back again of the Everything Code, and we found that in 2021 and 2022, they'd actually lengthened the duration because rates went back down to zero, and they lengthened the duration of the debt maturity to 5 years, just over 5 years. And then it's like, oh, I get it. Normally, year 4 of the cycle is when they have to do all the printing. It's the year of the most amount of debt refi payments. Now it's gone out a year to year 5. So it's 2026. So kind of that's what I'm looking at within this whole structure and trying to understand why it's been slow is because liquidity wasn't required yet. The liquidity really is required in 2026 because we've got $10 trillion to roll. So it's really been that. There's also more tokens in the market.
Yeah.
And so to find the thing that's getting traction requires work or astuteness in sifting through tens of thousands of assets prices, which is why I always say don't do that. Use the don't fuck this up thesis and just make it easy for yourself. Own mainly big stuff. Don't go too far out the risk curve. And if you do it with a small amount of money. You and I have talked about this endlessly.
Yeah.
And endlessly people go to me, well, you fucked up this cycle. Where was my banana zone? My tokens are down 90%. I'm like, where did I tell you to do that? I think we had the final low. So we had the October liquidation. So liquidity got withdrawn by the US government via the Treasury general account. We had an air pocket of liquidity from that. And then they shut down the government. And then now there's no liquidity because they can't even spend the TGA. So what happened was crypto, being the most liquidity sensitive, nuked and exposed all the weaknesses of leverage that you and I know so well. The whole thing nukes and it triggers this, issues with how the system calculates leverage and stuff. Okay, fine. We rally back. We've come back down. Some of them went through it. Some of them didn't go back through that low, but we're kind of basing around those levels. And then suddenly out of nowhere today, things are up 20%, 30% in a day. And you're like, okay, the signal is probably there. So the dip zone, again, nobody needs to buy the absolute bottom, but that dip zone has been forming from November because after October, we had the November pullback and then into the end of November, we had the final sell-off and somewhere here feels like it's there. Now, looking forwards, if I'm right in all of the work that I do about liquidity, we've got a flood of liquidity coming. So right now, the system is telling us the banking system is constrained and it keeps causing spikes in money market stuff. There's not enough money around. The Fed know it. They stopped QT. Okay, one job done. But the other job is they've got to get through year-end funding. There's not enough liquidity for the banks to roll their debts and to do their balance sheet work. So the Fed are going to have to inject some liquidity. It'll be some 3-letter acronym based in the repo market or whatever, but they have to do it. But they made a huge announcement most people don't understand, which is the ESLR, another nice acronym, and the supplementary leverage ratio means nothing. They never do these things. What they've basically said is what we used to say, US Treasuries carry this much risk. And so on your balance sheet, we're going to penalize you for holding them. But then the less risky asset, so they've got this tug of war with the banks of what they want to do. And they've just said, you know what? We're going to shrink how much risk you have to put on your balance sheet by owning treasuries. What does that mean? It means the banks will buy a lot of treasuries, which is what the government needs to do, is sell treasuries. That's their job right now. So the banks can use treasuries. You're hearing Scott Bessent saying, we want the money to flow to Wall Street, Main Street, and not just Wall Street. What he's saying is, we don't want the central bank to do QE. Every moron on Twitter goes, see, they're tightening, they don't want anything. What they're saying is, oh, we're going to let the Treasury print money instead and stuff it down the necks of the banking system. And the banks, being so good at what they do, lever it up and lend it out or provide liquidity. So the entire apparatus of managing the debts is moving from the Fed to the government. So the government creates its own buyer for its own treasuries. It's an easier way to debase currency. But the ESLR changes are important because the system's screwed up because of these changes after the financial crisis. So that was announced, rushed through, because I'd been writing about it and I was like, they'll announce it sometime in Jan, Feb that they're going to implement it. No, came through, straight out, done. We've agreed it with the banks, we're doing it January 1st. I'm like, wow. So that tells you they understand the game. The moment it was announced, and Steve Mirren had been pushing this thing through, the moment it was announced, Steve Mirren published another paper that day and said, good job, not enough. We need to reduce all risk weighting on treasuries. So 100% no risk for treasuries. So now there's an unlimited purchasing of bonds that can happen when needed. And you can really expand the money supply. And that, because it's credit, ends up going to ordinary people. They also buy more bonds, which lowers the long end of the bond market, which lowers the mortgage rate, lowers the government funding. It's a big deal. We're talking, this is going to end up being 3 to 4 trillion, maybe 3 to 5 trillion of extra liquidity. Oh, and then we've got rate cuts. Oh, and then on top of that, we've got $1.5 trillion probably in direct banking system deposits coming out of the new stimulus. I mean, don't forget, every single service worker in America gets paid on tips. They're all zero tax. So you're freeing up a ton of disposable income, mortgage rates come down, all of that. So that unleashes the business cycle. So you've got a lot of liquidity things happening all at the same time. In the middle of that, you've got the Clarity Act, whether it comes end of this year or by mid-Jan, it's coming. And that allows everybody to use crypto because it will have been defined on how to use it. So we've got an extraordinarily powerful year ahead of us. We've had to go through the hard part, which was this liquidity squeeze, but that will give us what we want going forwards. We then get the explosion of stable coins. This explosion of stable coins allow the government to issue more bonds because we've got these new holders who could be anybody in any country now are basically owning government bonds via stable coins. So the money is coming to roll the 10 trillion of debt. Meanwhile, the Chinese are printing money. Their balance sheet's increasing. The Japanese are doing massive fiscal stimulus. And so the game is on. Hold the right assets and do nothing. And don't rent conviction from people. Do your own work. And then you'll find your own conviction. And that's a really important thing. And don't look for a low price in terms of unit cost. And then find a echo chamber of narrative that comes around that. We've all done that in the past. Just openly look at the space and say, how much risk am I prepared to take? What is my goal here? Am I trying to compound wealth, or am I trying to get my starter pack of money to play the casino with? I get that speculative side, but you can do it in a smarter way and just have a time horizon that is realistic. And looking at it 3 months, 1 month, 9 months, 1 year still doesn't make sense. My entire thesis is the length of the cycle. I think the length of this cycle is 5 years. I changed my view. I thought it was going to be 4 years, but my forward-looking indicators kept pushing out. And I'm like, why is this happening? And then I realized the debt. And so 5 years is my time horizon. Everything else is just fucking noise.
Throughout the discussion, Pal repeatedly stresses discipline. Most investors, he argues, overcomplicate crypto by chasing obscure tokens far out on the risk curve. When those assets collapse, they blame the cycle rather than their own risk management. His advice is clear: focus on large, liquid, adoption-driven assets. If you speculate, do so with small amounts and realistic expectations. The deeper you go down the risk curve, the greater the volatility and drawdowns. Pal also cautions against narrative-driven investing. Low prices often attract echo chambers of justification. True conviction comes from independent work, not borrowed beliefs. Investors should define their time horizon clearly, months versus years, and align their strategy accordingly.
Over time, you get this redistribution of people who own a lot early, like we're seeing in Bitcoin now, and then they sell out, the distribution base widens, and really in the end, when punks are maximally valuable is when there's 10,000 punks holders. And we all think our punk is us. That's when it's maximally valuable. There's been really interesting things like an X copy. There's one of ones that have sold for a lot, but they're very illiquid because you need a lot of money and nobody's got enough money right now because crypto prices aren't high enough. But there's two assets. One is called Last Selfie and one is called Mortal. These are one of 10s. So there's 10 of those. And what we found is these have gone up faster in price to crazy valuations because you have a 1 in 10 chance of trying to get somebody to sell you one. The one of the X copy, you can't get. The one seller doesn't want to sell it to you, you pretty much can't sell it. And a lot of these people don't give a shit about how much you offer them. But when you got a 1 in 10 chance to get one of these things, it's driven prices insane in some of these things. And these are from long-term collectors. They're bad investments. They're not being used. Sure, some can become memes and they can capture attention for a period of time, but persistence in memes is very difficult. And then what people don't understand is there's even a risk curve amongst the major tokens.
Absolutely.
So Bitcoin, it drew down, 30%. Ethereum was 40%. Solana was 50%. Sui was 60%. 65%. They're all a risk curve depending on how mature they are and how many users they have and the depth of the markets.
Pal highlights that even within crypto, there is a clear risk hierarchy. Bitcoin, as the most mature and liquid asset, experiences smaller drawdowns. Ethereum draws down more. Solana more still. Smaller tokens and NFTs sit at the extreme end of the risk curve. As adoption widens, ownership becomes more distributed and volatility decreases. This process is already visible in Bitcoin today. Over time, value accrues to assets with the deepest liquidity, strongest networks, and widest user bases. Raoul Pal's message is ultimately one of patience, clarity, and structural understanding. Markets feel chaotic in the short term because liquidity flows are complex and often hidden. But in the long term, the forces of debt, debasement, and adoption are remarkably consistent.